When you invest long enough, you will collect a fair share of "I should have sold" and "I should have bought" and "why did I ever buy that" moments. That is just part of the deal. You cannot avoid them completely. So today, let's talk about when those regrets tend to hit the hardest, how to handle them wisely in the moment, and what investing principles can help you minimize them going forward. The regret that probably stings the most is, "I should have sold." And that feeling hits hardest exactly when the market is doing what it is doing right now, falling apart. You watch the chaos, you watch the numbers drop, and suddenly your brain is flooded with "I knew I should have gotten out," followed by "should I sell now?" and "or should I actually buy more?" All of it swirling around at once. Here's the thing though. Stock prices are essentially the collective best guess about the future. So when war breaks out, markets shake. And when it is a conflict in the Middle East specifically, it hits oil prices, which hits inflation, which hits interest rates, and suddenly the whole thing is wobbling. Looking at the month after Iran entered the conflict, US markets did not just cliff dive all at once. It was more like a ball bouncing down a staircase, dropping, bouncing, dropping again. And these days, with AI-driven trading algorithms reacting automatically to every major price move, those swings get amplified fast. It is like a fire that already started, and then the wind picks up. Which is exactly why how you respond in moments like this matters more than almost anything else. The first thing you should not do when the market is crashing is panic sell. Now, if you have looked at your portfolio, thought it through rationally, and genuinely decided it is time to sell, then sell. That is a real decision. And if you are selling to strategically rebalance your portfolio, that is a legitimate move too. But selling simply because prices are falling and you are caught up in the panic? That is the one to avoid at all costs. That is not a decision. That is the market's fear making the decision for you. Some people have a different version of this. They sell during a crash thinking, "I will get back in when it drops further." And look, if you can actually execute that well, it is a smart strategy. But it is a lot harder than it sounds. First, you have to sell near the top before the real crash begins. Good luck timing that. And then, even after you have sold, you have to sit there watching prices fall and actually pull the trigger to buy back in at the right moment. Most people cannot do it. They keep waiting for even lower, and then the market recovers, and they end up buying back in at almost the same price they sold at. At that point, you might feel relieved that you did not buy back at a higher price. But your whole plan, buy low and profit from the recovery, completely failed. And after you factor in transaction fees and taxes, you actually came out behind. Trying to time the market is a game I think is too hard and too risky for most people to play consistently. So in moments like this, when the market is in free fall and you are not sure what to do, doing nothing is often the smartest move. In investing, unlike baseball, you do not strike out just because you let a pitch go by. You can stand there all day and not swing, and nothing bad happens. If the market is shaking and you genuinely do not know what to do, especially if you are a long-term investor, one of the best strategies is to simply not ride the wave of panic. Step back, focus on your work, your family, the things actually in front of you. That is a legitimate strategy. That said, there are two important conditions for that to work. First, you need to believe that the fundamentals of what you are invested in, the company or the index, are not actually being damaged by whatever is causing the volatility. If you believe the underlying business is solid and the drop is driven by external noise like a war, rather than a structural problem, then you can afford to sit still. Second, the best long-term strategy is consistent, time-based investing, putting in money on a set schedule regardless of what the market is doing. So even if you are choosing to stay calm and not react to the chaos, do not skip your scheduled investment. That is the whole point of dollar cost averaging. The ability to keep buying during a downturn is one of its biggest advantages. We all want to buy at the absolute bottom. But honestly, how would you even know when that is? Some of you may have nailed a bottom entry before. But let's be real, that was luck. So the question is, should you keep buying even when the market is gripped by war-driven fear? My answer is this. If you believe the index or company you want to hold has strong fundamentals, and the reason it is dropping is an external factor like geopolitical conflict rather than something wrong with the business itself, then yes, I add to my position. I will be honest with you. When markets are crashing hard, my instinct is not, I need to sell. It is, I need to buy and fast. That is just how I am wired after years of long-term investing. But I also know that nobody can call the bottom. So I do not rush in all at once. When fear is dominating the market and prices are falling hard, I take whatever extra cash I have and divide it into 10 equal parts. I put the first part in right away, and then I wait and watch before deploying the rest, spreading it out over time. That is exactly what I did this time around. I divided my available cash into 10 portions and bought in gradually as the fear peaked. But no matter what, I always go in with a long time horizon. Because nobody catches the exact bottom. Nobody. And one more thing. When you are buying into a falling market, it must be money you can afford to leave alone. Do not borrow money. Do not take out a loan to invest in a crash. I cannot stress this enough. The downturn might be short, or it might stretch on for a long time. You never know. Taking on debt to buy a falling market is one of the most dangerous things you can do. But through all of this, the chaos, the fear, the uncertainty, what makes you a long-term investor is the belief that markets will be higher over time than they are today. Warren Buffett said it best. The stock market is a device for transferring money from the impatient to the patient. That is what we believe. That is what we are betting on. Now, I will admit, even when I am being strategic, dividing my cash and buying in portions, the days I actually make those purchases are nerve-wracking. I find myself checking the market constantly, watching every tick. Even after all these years of long-term investing, I still do it. I think that is just part of being human. So here is what I believe you need to get through moments like this. 3 things. An unshakable mindset, a genuine belief in long-term investing, and available cash.